How do you fix the reverse mortgage program and expand its availability? Researchers presented their ideas last week, so stay tuned for your exclusive recap. There is no shortage of ideas when it comes to just how to strengthen the federally insured reverse mortgage program and at the same time expand its reach to older homeowners. Last Monday, the Brookings Institution hosted a symposium entitled Reverse Mortgages, Promise, Problems, and Proposals for a Better Market. Participants included AARP's Deborah Whitman, Stephanie Moulton from Ohio State University, University of British Columbia professor Thomas Davidoff, we interviewed him a few years ago, Longbridge CEO Chris Mayer, and Lori Goodman from the Urban Institute. The event is part of the Brookings Institution and the Kellogg School of Management's meetings on retirement security and the challenges therein. Now, these are not pending proposals for the home equity conversion mortgage that are before Congress or even FHA, but they are very important. So these policy think tanks play a very key role in our federal government. They help shape public policy. Now today we're going to highlight some of the more interesting proposals that were made and the comments during that event. So buckle in as we review the most relevant takeaways from the event, and don't forget to smash the subscribe button for YouTube and also share your comments below. First, Stephanie Moulton. She resurrected the idea of what many of us remember back when as the HECM saver.
There's two different product options that we think could be streamlined that would allow for meeting these consumer segments. One is a small dollar reverse mortgage. So the idea here is to virtually eliminate crossover risk by providing an amount of equity that is still meaningful to that older adult.
Now, despite its lackluster perception in the market when the saver was first introduced, she estimates over 12 million homeowners could actually benefit with an initial draw of $20,000 and still be at 30% or less of the home's loan-to-value ratio. Now, do the HECM's upfront insurance premiums support this idea? And why did the HECM saver not gain a significant share of the marketplace?
Challenges right now, while they could do this, the upfront mortgage insurance premium, for example, is a flat 2% for everybody, regardless of how much you draw, and that actually can make it more costly for somebody wanting a small dollar reverse mortgage. There was something like this in the market previously called the HECM Saver, you may be aware of. That was in 2009, but it was actually launched at a time when the market was all moving towards fixed rate reverse mortgages full draw, and it really had difficulty competing at that time in the market, and we think that that kind of a product today might have better legs.
Despite claims of its effectiveness in reducing property defaults, it appears that many are now realizing the financial assessment is not only consuming considerable time and resources from lenders, originators, and borrowers alike, it could be turning some away from the loan itself. Is there an alternative?
As you might know, another issue in this market is making sure that individuals are not in default on their property taxes and homeowners insurance. And so what we would propose is that we streamline this, that we use credit score as kind of a risk indicator, knowing that above 680 is very little risk of default. Perhaps you could streamline underwriting for those individuals and require the more detailed financial assessment for individuals with credit scores below 680. And then perhaps even make the LISA, the life expectancy set aside, which is going to help cover the property taxes and insurance, the default option for anybody with credit scores below 680.
Moulton also argues that defaults can be reduced after the loan has closed.
We think preventative servicing, we did a simple experiment with actually a counseling agency where we provided reminders to pay property taxes and insurance, and we actually reduced default by almost half among individuals that got those reminders. Now, that seems like a no-brainer, and many servicers, again, may be doing this already, but some aren't.
The moderator of the event, Ben Harris of the Kellogg School of Management, a man who is very well versed on many financial topics, said this.
Can I just stop in for 1 second and say, I find this incredibly complex. So I usually study taxes. Reverse mortgages blow taxes away on complexity. Both the details of the particular loans, how the programs work, the reforms that have happened. You saw Stephanie's chart up there. I mean, this is a program which is transforming before our very eyes almost every year. I find it really confusing.
However, Longbridge CEO sees it quite differently.
But it's actually not a terribly complicated product. And I think we've made it more complicated than needs to be. I think maybe we should have fewer options for people to convert back and forth with plans, to have to look at different kinds of products, to show consumers different kinds of products which are very different. Maybe we should have sort of one standard line of credit product. You can't take all the money out up front.
Early in my reverse mortgage career, that was back in the mid-2000s, 10-year or annuity payments to the borrower each month were not uncommon, and they were often the choice of those that were seeking a predictable monthly cash flow for the rest of their time in the home. Now today, that's no longer the case. And speaking of annuities, University of British Columbia professor Thomas Davidoff had one unique solution to help prevent crossover risk in the HECM program. That's where the loan balance exceeds the home's value.
That life annuity, under sort of normal interest rate scenarios with no spread, would pay just enough to the lender that the initial cash to the borrower plus the loan, because the life annuity gets an interest rate because of the mortality premium greater than the interest rate in the economy, that loan, that annuity can pay off just enough interest so that the loan to value stays constant. You increase loan to value early in the life of the loan to buy a life annuity, and that life annuity over the course of the loan, as long as the borrower's in the home, is paying down principal. So you do start with a higher loan to value, but you never get this rapid escalation. There was some, they used to annuitize. It was a reverse annuity mortgage.
However, some see consumers wanting quite something else.
And I really think for most seniors, the surveys show this and the data show this. The reason people don't want to annuitize, I think, is because annuitizing is not meet the kinds of financial obligations people really have. I got to fix my house. I want to, take a family vacation, with the grandkids. I want to help out. I just got put in the hospital and I need 3 months of at-home care, to deal with my broken hip. They tend to be lumpy, irregular kinds of payments where having a line of credit substantially helps their ability to meet those obligations.
Lori Goodman addressed the issues of both the complexity and the consumer need when it comes to the home equity conversion mortgage's plethora of options.
When you go in to get a forward mortgage, do you want a fixed or adjustable rate mortgage? And what kind of mortgage term do you want, 15 or 30 years? That's it. You go in for a reverse mortgage. Do you want fixed or adjustable? What kind of, do you want a lump sum disbursement, line of credit, term annuity, 10-year annuity? Oh, by the way, you can have any combination of these. Choose your ice cream flavor. And then also the timing and pace at which funds are going to be withdrawn. It's just such a complicated, program. I would actually just basically get rid of the annuity option entirely because only about 6% of borrowers took advantage of it. 2% of borrowers opted for a term or 10-year annuity, and another 4% opted to combine that with a line of credit. So just get rid of that, and then on the line of credit, put a 10-year restriction. So you can have your payment up front. You can do a line of credit. You can do a combination of both, and your line of credit is good for 10 years.
Now, what are your thoughts on these unique policy proposals? Well, you can leave those below. And also, if you've not got it in your inbox already, be sure to check for the October Top 100 HECM Lenders Report. Have a great week.